Hey, Financial Advisor Group world. It is what is it? Tuesday, June 24th. Welcome to summer and to another edition of our favorite show, Rapid Fire, with Ben and myself. And we were doing the count. We're all the way up to number seven, right?
Yeah.
So I don't know, Ben. When we started, we hope we at least got to five. We're beyond that, and double digits are coming.
Yep. Soon we'll be at 100. I think I saw something before that like 99% of podcasts don't make it to episode 100. So
Wow.
we'll have to beat that statistic.
There's our goal. There's our goal. And it's
Yep.
a the good slash bad thing is it's not like there's a shortage of topics this year or recently, right? So as we were
Mhm.
getting together, sort of thinking through what to cover, it wasn't that difficult because I think the last one we made, we sort of joked, nothing much has changed, right? Well, I think in the last couple weeks or week, there's been some interesting developments. So we'll get to that.
Yeah.
But again, welcome to Rapid Fire number seven. Happy summer. I'm sure we're all dealing with the heat, but without further ado, I'll turn it over to Ben to sort of take us through our first topic.
Yeah, it's kind of feeling like fire outside. So maybe we should call it like rapid ice or something this
Right, I like
episode.
that. We could take
Uh
that.
Yeah, but kind of to start off, we want to talk about something that we touch on a lot, which is kind of just being prepared in general. Again, like we talked about buckets before, but just to kind of put in perspective, we already had this year a 20% drawdown. Now it was pretty much just a week long. If you pretty much went to sleep in March and woke up in April, you probably would have missed the whole thing. But just to kind of put it in
And when
perspective,
you just Ben, sorry to interrupt, when you say 20% drawdown, what does that mean just from like a market's perspective?
yeah, good question. So like when we always say the market, that's like the S&P 500, the 500 largest companies in the United States. And when I say a 20% drawdown, I'm basically going from like peak. So if the S&P is at what's like 6,000 and it drops to 5,500, that like peak to trough, that
Gotcha.
drawdown is what we're quoting as like a 20% drawdown. So
Okay.
with that said, it's like a 20% correction, bear market, whatever you want to call it. The odds are actually pretty high that those things happen. In a given year, you have a one-third chance of a 20% correction, which is probably a lot higher than you would think. A third's a pretty high amount. But as you stretch this longer and longer, we're all long-term investors here. It gets pretty high. I mean, if you're around, like, if you're investing for at least 10 years, which is almost all of our clients' time horizons, much past 10 years, you're going to hit some sort of correction. 20%, it doesn't feel comfortable, but there's at least a little comfort in knowing that it's normal. It's something that happens. It's regular. The thing is that we just want to be prepared for that. So that kind of goes into a discussion that we've talked about a lot recently. We had the 20% drawdown, and thankfully the market kind of came back a lot. So right now, again, we're kind of doing the same thing where the market's at a good point. We're kind of getting clients prepared for maybe the next one, or even just some heightened volatility, putting some money aside, putting things in money market CDs, kind of having that income set aside for those that are taking the income or have big projects coming up, kind of all of that.
Yeah, it's almost like we always talk about the longer you invest, the more your success rate will be, which is true, but it's like congratulations, the longer you invest, the more likely you're to encounter a bear market. Right?
Yeah.
Wow, that sounds wonderful. But I think again, it goes with make a lot of comparisons to the weather. We can't predict the weather, but storms are going to come. Our view with the markets is we know a bear market's coming, especially if you're with us long enough. We can't predict when they're going to be, but if we're prepared for that storm, then we don't need to worry as much about it. But it's congratulations, you invested long enough, you got through a bear market. But that is, right, it's part of investing.
Yeah.
Uh,
Getting into kind of like next topic, one of the things that we would say, like, of course, there's a lot of volatility this year. There's a lot of headline risks. One thing, like, we try and kind of get away from all the news. Like any of those headlines, they're going to affect short-term prices, but in long-term investing, the market kind of goes back to fundamentals. Like our companies producing more? Are they getting higher revenues? Are people employed? Are they, not employed? So one of the economic indicators we look at is employment. That's employment kind of drives everything. We always say in client meetings, if the employee is happy, if they're, getting bonuses, making more money, they're probably going to go out and spend money. They're going to go buy the new Apple iPhone. So, yeah, Damien, what are we seeing on kind of the employment front lately?
Sort of two sides to this, right? And I think this is where we've talked in the past that the cushion for the economy is getting smaller for sort of what we can absorb. So we'll start with the good news. The good news, like Ben just said, there's a lot of people still working. And because there's a lot of people working, there's a lot of income out there. So real income, the amount of money that's literally really being sort of paid out to individuals in this country, no surprise, is at the highest level it's ever been. Well, we've said it for however many years, 25 years. If people make money in this country, what do? They spend it. We're good at that. The flip side, though, which we are starting to get a little bit concerned, is that the growth in the job market is slowing down. So we're still creating jobs, but the pace that we're creating them is a little bit slower. And Ben, if you want to bring up the one chart, we can just highlight sort of what we mean by this. And it's pretty evident to see when we look at the visual of it. But if you look at the chart that's going to be on the right-hand side up here, you'll see that in 2021, we added 600,000 jobs a month, then 380,000, then 217, to now we're down to 140,000 jobs, still creating 140,000 jobs a month, but the pace is slowing down. And I heard a good analogy the other day of sort of comparing the job market to a bathtub. And stay with me here for a minute. I know that's a weird one, but if you look at the faucet letting water in is like people getting unemployed. So they're pouring into the bathtub. On the flip side, there's also the drain where the water's coming out. The drain is people leaving the unemployment market and finding a new job. So if the water coming in, the water and going out is at the same speed, the water never gets higher. It's not a concern, right? You're not worried about a flood. And if the water coming out of the drain is going faster, that's a good thing. The problem we're seeing now is the water is slowing down coming out of the drain. There's not as many jobs being created as fast. There's not faster water, if you would, coming out of the spigot. But because there's not as many jobs being created, the bathtub's starting to fill a little bit. So visually, that helped me a lot to say, okay, that's not like the water's coming out any faster. We're not losing tons of jobs, but the creation side is slowing down a little bit. So it's just one of those things that perks our ears up a little bit to say, okay, there are signs that this thing isn't as strong as it was, and hence why you hear some discussion, should the Fed cut rates? It's some of these things that there's little signs out there that show, things are getting a little bit weaker, if you would. But again, big picture, it still looks okay. We just need to pay attention to the fact that water is starting to rise, Ben.
Yeah.
Um,
Yeah, it's getting weaker, but that's also weaker off of a very, very, very strong economy. So yeah,
correct.
it's just a trend that's not going in the right direction. So something we keep our eyes on, and again, why we kind of keep our clients prepared. But yeah, something kind of when you were talking through that, I think we'll need to call the plumber at some point. The plumber being the Fed. So
Yep.
think of
I
the
like that. That's a, you take that analogy. Yeah, who knows the things we discuss, like bathtubs and the Fed being the plumber. But and I think that's part of the Fed's job, is to see the water rising, if you would, and don't wait till it's overflowing, right? If you wait till the tub's overflowing, it's too late. And I think once the water starts rising, this sort of goes back to our cushion. There's less cushion left in the economy, and that gets to our next topic, which is the topic of the week or the topic of the weekend. And we don't mean this in any sort of belittle sort of what happened over the last couple of days and week of what's going on in the Middle East, because as humans, this is the hard part. It's not fun at all to see what's happening on the news. But when you look at the market side of it, one of the fears we have is that we don't have as much wiggle room. Well, then, Ben, my question to you is, we're saying the cushion's softer, we don't have as much wiggle room, yet bombs are flying over the weekend and the market goes up Monday and Tuesday. Can you riddle me that one?
Yeah, that's a tough one. I mean, with any of these, again, like headlines will always swing the markets. But the good news is, if like we're never saying bombs are good, but in terms of the market's perspective, if the market isn't even reacting to a certain headline, that usually means it's not going to influence short-term or long-term pricing in terms of like the market or companies' growth, things like that. So kind of reason behind that, when Damien and I kind of dug into it, is looking at oil. Oil, thankfully, the United States, and I think we've brought it up in prior discussions, similar to like the Ukraine-Russia conflict. United States produces a lot of oil. We're not as impacted by oil shocks, specifically through the canal where most of the oils ship through.
It's almost like anything in life when you're not as dependent by becoming more energy independent, which has been this country's goal for not 5 years, but for 10, 20, 30 years, we've been on this path. Then when shocks like this is the whole, if you call it benefit of oil and energy independence, if you would, is that the less dependent you are in the rest of the world for that energy, the less you get shocked by these type of events. Does that make sense, Ben?
Yeah. Yeah, so we haven't really been a factor of that shock. Sure, if you're investing 100% in China, which we'll get into, maybe you'd see some impact in your stock market portfolio. But we are definitely not investing 100% in China. But before we get into that, if you look at the chart on the left, this is kind of why we don't have a huge reliance. The U.S. produces a lot of oil, a lot more
Hmm.
than people would think. Actually, one of the largest oil producers. You can see in 2025, we're producing 23 million barrels per day of
That's a
oil.
lot of oil.
That is a lot of oil. And we're only consuming 20, only consuming. I mean, that's still a
Mhm.
lot, but we're the biggest or one of the biggest consumers of oil. But we're producing more than we're consuming, so everything's good on that. And also our growth, you can see from 2019 to 2025, and we're really trying to ramp up production and kind of not be as reliant on other countries for oil. We've seen an 18.5% growth in that production. So pretty good. Another reason why the market, the U.S. investments really haven't been impacted by a lot of these headlines.
Well, and I think if you go back, Ben, to, if you go back the last 30, 50 years, the oil shocks we've had have been pretty significant and pretty severe, where you've had things happen like in the 70s, the energy crisis, then you have the Middle Eastern conflicts of whether it's the 90s or the early 2000s, and the impact on the oil market specifically was much higher. And the oil will impact the stock market because that could bring in inflation. That could bring in other, if we're spending more on energy, we have less to spend on other things. So again, the good news today is because we aren't as reliant on others in the world to get our energy, you don't see the market being as volatile with that. Now, again, we're not saying bombs dropping is a good thing, but what we're saying is there is a reason we that think it's not as sensitive to that anymore. And I think that's the part to us. It's encouraging to see that we're not getting pulled into that as much. I think if we're just going to be the worrisome thing, we'd say big picture is just that the bathtub's filling up a little bit. That overall, that this economy isn't as strong as it was 4 or 5 years ago. But big picture, people are working. They have money, and as we've said it before, again and again, they're spending it. And we're heading into summer where we tend to like to spend money.